Well, the Reserve Bank will announce its call on interest rates later this afternoon. The market is widely expecting that Governor Lesetja Kganyago will announce a further 25 basis point cut in the repo rate. This comes on the heels of the U.S. Federal Reserve deciding to keep rates unchanged in that country. Consumers with heavy debt would benefit from a further cut, but such a move wouldn't be so great for those with bank deposits. Well, to share their views on what we can expect, I'm joined by Dr Frank Magwegwe, who's become a regular in our studio. He's the executive for financial wellness at Nedbank, and virtually Hannah de Nobrega. She's an economist and quantitative analyst at Prescient Investment Management. Thank you very much to both of you for joining us.
Great to be here. Thank you.
I'm going to follow the rule of ladies first.
Yeah, I'm happy with that.
And start with Hannah. Hannah, thank you so much for joining us. So to what extent do you think the Fed's decision to keep rates unchanged in the United States will affect the SARB's decision today, given the fact that as a country we do need to be mindful of what they call the interest rate differential between South Africa and the United States, because we still want to be able to attract foreign investment into our capital markets?
Good morning, Nompu. It's amazing to be here on your show today. So South Africa doesn't follow the Fed one-to-one in their interest rate cuts. If we consider pre-COVID, the situation just before COVID hit, or just as COVID hit, we saw EM or emerging market economies start to raise interest rates really early, and then South Africa lagged a little bit behind, and then the Fed started raising their interest rate quite late. And the same sort of trajectory followed coming down on the cutting cycle. So other emerging markets such as Brazil and Mexico started cutting really early. South Africa started cutting just after them, and then the Fed started cutting a couple after that. The Fed's decision not to cut was mainly placed on the fact that their inflation is quite sticky. South Africa is not feeling that at the moment. We're actually seeing an inflation come down. Our inflation has come down quite a lot. And it's only very slowly starting to raise up. I mean, they just did to wait on getting on just a bit below the latest print of 3%. So the SARB considers the domestic environment, so what's happening in the country. They consider the global environment, what type of inflation are we importing. That's a very important consideration, because we are a small open economy. We basically do import some. We're expecting to import some inflation from China, but import some inflation from the US. And then overall, as well, what the SARB really considers is where should the economy, if we are...
Hannah, I'm going to come in there because something's happening with your line. My colleagues and you will deal with that while I speak to Mr. Frank here, and then we'll get back to you. Thank you so much, Hannah, for that contribution. Dr. Frank, so we've had an interest rate or a cumulative interest rate cut of 50 basis points already, and we're expecting a further 25 basis points. To what extent do you think this is really going to impact the consumer's pocket, particularly those who tend to be heavily indebted?
I think it does help, and what I liked in the clip that was played earlier is really consumers starting to have this expectation that should rates be cut, and planning what to do. So I did a quick calculation before I came in. If you have a bond of about 1 million, we're really talking about just under 300 rand that will come into your pocket. So in other words, your repayments will be reduced by that amount. Not a substantial amount, but what's important is for consumers who are struggling with debt, as they have been for a while in South Africa, is to be disciplined and make sure that that cut, you make something out of it by either saying to, you know what, let me keep my bond at the same level. That's one thing that one could do. Or to say, if you're under pressure somewhat, let me use some of it, but let me also make sure that I benefit by reducing debt.
Indeed. So we're still waiting for Hannah to come back, yes. So we'll continue.
Happy with that.
How do you think the consumer is faring? I mean, we saw the retail sales stats for November. They were staggering. They were like up nearly 8% year on year. We know that part of that is obviously because it was the Black Friday month. But what else do you attribute to that, and can that be sustained into this new year?
Yeah, I definitely think so. I think what we have seen over time now is a consumer who has become quite savvy in terms of the cost has been high, cost of living, and therefore people are quite creative in terms of, for example, some consumers would say, I'll buy my fresh goods here. I buy my meat here. I buy my, your dishwasher, your sort of cleaning, household cleaning goods. I buy them somewhere. So I expect, and as Nedbank, we also expect to see kind of the consumer carrying on that. And as a result, they have been spending wisely, and they have some income they may have to spend on other things. I think that's what we saw, of course, at the end of last year. It was driven by Black Friday, or the deals that come, the cyber deals that follow. But I think the consumer has become quite savvy on where they want their money to be. That's one thing we've seen at Nedbank. I think another interesting thing that we saw in our Netfin Health Monitor, for example, is a consumer who's also said to themselves, wait a minute, it's not only me who's got debt. Debt is quite a common thing. So we've seen consumers who, at the same time as they are building emergency savings, they're actually prioritizing that, as opposed to a consumer says, I want to pay off all my debt. So I think the post-COVID, what you have seen with interest rates, the cost of living, has really made our consumer quite savvy, just in terms of managing and stretching that rent, and in making calls like, I need to have emergency savings, but I do also want to reduce debt somewhat.
Yeah. Part of the reason we saw that retail sales number go up was obviously the two-pot. And the Reserve Bank telling us that about 50 billion was claimed, which is a substantial amount of money. Some was spent on bringing down debt. Others, was spent on the retail environment. But how concerned are you about that? Because people are going to be able to have access to this every year. And what would your advice to people be about the temptation to tap on their funds every year?
We're very concerned as Nedbank, not because we don't want individuals who find themselves under financial stress utilizing that savings pot. What we are saying as Nedbank is this: it has to be the last resort. The reason we say that is when you take into account the tax at your average tax rate, for most consumers, it is an expensive way of accessing money. And therefore, we're saying it has to be as a last resort. In other words, you've gone to financial services providers and you are not able to access debt, and therefore you go that route. That's kind of our message. What we are also concerned about is the point you are making, that once individuals get used and they know that money is there, available for them, the temptation to tap into it, where you just say to yourself, this is an emergency, and then you go and access, is quite high. So what we need there, Nompu, is continued education to say, you don't have to take the money. You only need it in extreme circumstances, because you are eating into your retirement savings. So education, education, education.
And discipline, discipline, discipline. Hannah, thank you so much for joining us again. I just wanted to ask you, even though there's an expectation that the Reserve Bank will cut interest rates by 25 basis points, there's uncertainty as to whether that will continue come March time. We're seeing the Fed obviously deciding to keep rates unchanged. And there's a lot of concern about what the inflation horizon is going to look like in light of the policy stance that the United States is taking. How much of a concern is that for you guys there at Prescient? Do you think that perhaps this is the last time that we're talking about inflation being manageable and therefore interest rates cuts being more probable? All right.
Sorry, I couldn't hear the question. I'm just having some technical issues on my side.
Oh, Hannah, can you hear me now? Oh, unfortunately, Hannah can't hear me. All right. No, we're going to leave Hannah for now. But I'll put that question to you,
Yeah.
even though you're very consumer focused.
Absolutely.
You obviously have an idea of the bigger picture.
Yes, and
right?
in fact, I spoke to my colleague, Isaac, our economist, yesterday.
Yes.
So to say, with this interview coming up. So I do have a Nedbank view.
Yeah.
And the Nedbank view is quite interesting in that it says often we begrudge the SARB when they come with we as consumers, right, at 25 basis points. If you look at last year, the last cut, where everyone said that should have been 50, what they did say was, there are global headwinds. We need to be careful of that, right? Perhaps the talk of tariffs with the new administration coming in and our rand, let's not forget that. So I think the Reserve Bank, our view as Nedbank, is they've been cautious, and that is welcome. We expected 25 basis points for 3 reasons. Firstly, inflation, we mentioned it earlier, and you can see some structural reforms starting to bear fruit. If, for example, we look at Transnet or the bigger sort of port challenges that we have seen, we are talking Eskom, which is probably in much better shape as far as load shedding is concerned. So we are happy with structural reforms, inflation remaining under control. However, there is still that concern of the new regime that is coming in the US, and what are we going to see in it's engaging with good, and almost that sense of it's America first, then everybody else. And therefore the Reserve Bank is in their right to be cautious, and the reason they have to be cautious, they don't only look at inflation now. Remember, it's current inflation, and more importantly, projected inflation.
Absolutely.
So there are quite a number of factors that are still up in the air. So we think they will take a careful stance. We expect 0.25 this time around. We expect another 0.25 later in the year. Our projection as Nedbank is 50 basis points for 2025, bringing prime to 10.75, and then we'll see the future.
All right, let us see. Thank you so much, Dr. Frank Magwegwe.
Fantastic to be here.
Thank you for joining us. He's the Executive for Financial Wellness at Nedbank.